As most of us are well aware, volatility has been particularly high this year, given the on-again, off-again nature of President Trump's threats on social media and his actual policy actions. The good news is that the market swing in May went very well for investors. It was actually one of the strongest months of May in history, with most global stock markets rising 4 to 6%. Overall, it's a good reminder. Investors should take old adages like sell in May and go away with a grain of salt. While seasonality can play a role in market movements, underlying fundamentals usually overshadow these trends. The North American economy is still holding up well, despite the tremendous uncertainty facing both consumers and businesses. Data has been skewed to the upside with unusual buying patterns ahead of the potential tariffs. Likewise, first quarter corporate earnings have exceeded expectations for the most part, which has been a relief for investors. However, it's important to remember that's yesterday's news. Stock markets typically act in anticipation based on what they expect over the next 6 to 12 months. Another point to consider is investors who had shorted the market. As prices climbed, they were forced to cover their positions. This added even more fuel to the rally. The most significant driver seems to be something called the taco trade, an acronym for Trump always chickens out. A comment on his reputation for consistently backing down from damaging policy proposals. We think this is a bit premature and maybe even a dangerous conclusion to make this early. President Trump's proposed reciprocal tariffs are on pause until early July, but they haven't been canceled. Investors are hoping for trade agreements with key partners to come forward, but we haven't seen much progress yet. Even if they are, we can see a world where some level of tariffs will stick around. Trump is clearly a fan of them, and there's still the growing need to increase government revenues. On May 16th, Moody's downgraded the rating on U.S. debt. American has been stripped of their AAA status by every major rating company now. This isn't overly surprising, but it did result in some upward pressure on bond yields. Trump's big beautiful bill has also added pressure and is now moving through the Senate after passing through the House. This proposed budget will likely add trillions of dollars to the growing debt burden over the coming years. The hope is that it'll be stimulating enough to lead to economic expansion and additional tax revenues, but experts are still skeptical. Tariffs are essentially a hidden source of tax revenue for the government that could help close the deficit gap, but that becomes a lot more challenging in a weaker economy. Less money, less spending, less revenues. The U.S. Federal Reserve is still on hold with a difficult choice: supporting the economy or battling a potential spike in inflation. Bond investors have been rightfully skittish. U.S. Treasury bonds are usually seen as a source of stability. During uncertain times, they attract capital, but that's not the case right now. A more obscure part of the budget proposal is the idea of taxing income earned by foreign investors holding U.S. securities. This is certainly concerning for any international players, but it's too early to adjust investment strategies. First of all, the budget still needs to get passed in the Senate, which might lead to some modifications. More importantly, it is certainly possible that this threat is another aspect of Trump's negotiating tactics with other countries. In theory, this proposal would override the current tax treaty between Canada and the U.S., but we are hopeful that this would be addressed in a broader North American trade deal. In any event, this adds another reason for investors to shift capital away from the U.S., which has suddenly become less reliable. The U.S. dollar is continuing to decline against most global currencies, including our loonie. This is despite the fact that Canada's underlying fundamentals would likely argue for a weaker currency. It's not our fundamentals that are strengthening, it's that theirs are weakening.